Welcome to the Deep Dive. Today we're giving you that shortcut, the inside track on ConocoPhillips, looking at their third quarter 2025 earnings call, the press release, all that supplemental stuff.
Exactly. Our goal here is really to cut through the usual corporate speak and synthesize what's going on. It's kind of a dual narrative this time.
Dual narrative, how so?
Well, on one hand, you've got really strong operational performance, solid execution, and these long-term promises about financial strength. But then, bam, the other side is this headline-grabbing news about a huge cost increase for the Willow project in Alaska. Mostly inflation, they say.
Okay, so good news operationally, but a big cost headache. We're here to sort of connect those dots for you, figure out what's really driving the bus here and what this mix, the good and the risky, means for their free cash flow.
Yeah.
That's the big story everyone's watching, right?
Yeah.
The next few years.
Absolutely. And starting with Q3 performance, operationally, things looked pretty smooth. Production came in at 2,399,000 barrels of oil equivalent per day, MBOED. That actually beat the high end of their own guidance.
Better than expected then.
Yeah.
And underlying growth.
Yeah. Underlying production grew 4% compared to this time last year, Q3 2024. So the base business is definitely performing.
Okay, and the financials. Adjusted earnings per share landed at $1.61. But the market wasn't exactly cooperating, was it? Crude prices were down.
Right. WTI was around $64.93 a barrel, which is 14% lower than Q3 last year. That definitely hurts the top line for oil.
But there's always a but.
But yeah, this is where their diversified portfolio really helped. While oil was down, U.S. Henry Hub natural gas prices surged. They were up 43%, hitting $3.07 per MMBTU.
So the gas side picked up the slack.
Pretty much. That mix of oil, gas, global assets, LNG, it does what it's designed to do. It smoothed out that volatility from the weaker crude prices and meant the strong operations could still, translate into decent earnings.
Okay, so that operational strength, that diverse portfolio, it generates a lot of cash. Sets the stage for their financial framework, right?
Right.
How are they deploying that cash, especially with shareholder returns in focus?
Well, the cash flow was definitely strong. Cash from operations, or CFO, for the quarter was $5.4 billion. Solid number.
And they're sending a good chunk of that back to shareholders.
Oh, yeah. They returned over $2.2 billion just in Q3. That breaks down into $1.3 billion used for buying back shares and another $1.0 billion paid out as ordinary dividends.
So year to date, that's a pretty significant payout ratio.
It is. It works out to about 45% of their CFO so far this year. They're definitely walking the talk on returns.
And they underlined that commitment with a dividend hike, did they?
They did. Raise the ordinary base dividend by 8%. It's now $0.84 per share. And they've been pretty vocal about their goal. They want top quartile dividend growth compared to the S&P 500. That's ambitious.
Very ambitious. But to make that sustainable, especially with big project costs looming, they need confidence in their long-term cash flow, right?
Right.
How do they justify that kind of dividend growth?
Exactly. Sustainability is key. It all ties back to their long-term strategy of driving down the company's free cash flow break-even price. They're aiming for the low $30 per barrel, WTI terms, by the end of the decade.
Low $30 break even. How are they planning to get there?
It's about actively managing the portfolio, engineering it towards that lower threshold. Two main levers: cost management and asset sales.
Okay, let's talk costs. I saw they lowered their full year 2025 operating cost guidance again, down to $10.6 billion now.
That's right. The second time this year they've cut it. Started the year guiding to $11 billion. So finding savings there.
What's the strategic importance of chipping away at operating costs like that, especially when you've got, this huge capital project cost increase elsewhere?
It's crucial. It shows they're managing costs on sort of two different fronts. These operating cost reductions give them immediate realized savings that flows straight to the bottom line, helps insulate them a bit from unexpected capital bumps like Willow.
And the other lever?
Asset sales.
Yep. They're pairing that cost discipline with strategic asset dispositions. They've already done over $3 billion in sales this year, and they're tracking towards a $5 billion target by the end of next year, 2026. Remember that $1.3 billion sale of Anadarko Basin assets? That just closed October 1st.
Right, so cost cuts plus selling off non-core assets.
It all works together to lower the overall company break even. That's what makes the increased dividend, that 8% hike, feel much more secure and sustainable, even with market ups and downs.
Okay, let's pivot now to the elephant in the room, the Willow project cost increase, a massive inflation shock, you called it.
Yeah, there wasn't really any way to sugarcoat this one. It was a big jump. The official capital estimate for Willow is now in the range of $8.5 billion to $9.0 billion. That's a significant increase.
So what happened? They did a full review, right?
They did a detailed bottom-up review, and management was pretty clear. About 80% of that cost increase is down to inflation.
80%. That's huge. What kind of inflation are we talking about? Just general price rises?
It was sort of a double whammy. First, yes, higher than expected general inflation. Across the board, general labor, materials, engineered equipment, they admitted they'd originally modeled, maybe a couple of percent inflation per year over the 5-year build. But reality has been closer to maybe 5% annually. And that difference, compounded over 5 years on a multi-billion-dollar project, well, it adds up fast. That was a big chunk of it.
Okay, so general inflation was higher than planned. What was the other factor, the localized pressure you mentioned?
Exactly. That's the challenge, the specific challenge of working on the north slope of Alaska. They ran into really intense, localized cost escalation. It turns out there was an unexpected overlap in peak construction timing between Willow and some other big regional projects.
So too much happening in one place at the same time.
Precisely. It basically doubled the demand in those specific stressed local markets. We're talking local skilled labor, trucking, marine logistics, even just having enough camp beds available.
Yeah.
That intense local competition for resources drove up costs significantly, accounting for another big piece of the increase.
Okay, so general inflation plus a very specific localized market squeeze. Was there anything else? Did they change the project scope?
Management mentioned a small component, maybe the remaining 20% or so, was related to some decisions they made to actively mitigate schedule risk. Things like pre-staging equipment earlier than planned to make sure it was there. So some proactive choices to keep things on track, but that added a bit to the cost too.
Right. And speaking of schedule, despite this huge cost blowout, they're saying execution is strong.
Yeah, that's the flip side. Operationally, they seem to be managing the build quite well. The project is apparently nearing 50% completion, and critically, they're maintaining the schedule. They've even narrowed the window for first oil to early 2029. So costs are up, but timelines are holding.
How does the finance team handle that extra spending now? Where does the money come from in the budget years?
They've laid out the phasing. This year, 2025, the spend will be just north of $2 billion, as they put it, but then it steps down. For 2026 through 2028, it'll be around $1.7 billion each year.
After first oil?
After first oil in early 2029, the capital required drops off significantly. It becomes sustaining capital, keeping the wells flowing, which they estimated around $500 million a year, much lower.
Okay, the big question then, does adding maybe $1.5 billion or more to the total cost kill the project's economics? Is it still a good investment?
That's obviously a key concern. It definitely increases the finding and development cost, the F&D cost. They estimate it adds about $2 to $2.50 per barrel of oil equivalent. That's not insignificant.
But they still think it's competitive.
Yes, management was adamant that Willow remains very competitive within their global portfolio. The key reason, Alaskan oil is, well, it's 100% oil, no gas liquids mixed in. And because of where it's located, feeding into the West Coast market, it consistently sells at a premium price compared to the international Brent benchmark.
So that price premium helps offset the higher upfront cost.
Exactly. It provides a buffer, helps absorb those higher capital costs, and keeps the overall return profile attractive within their investment options.
This whole situation, though, this massive investment, even with the increase, it really cements Willow as a core long-term asset, doesn't it? You don't spend $8.5 to $9 billion if you're not thinking decades ahead.
Absolutely. This isn't just about the initial Willow reserves. This infrastructure investment is strategic. It's foundational for their future in Alaska. Management confirmed they're planning a much larger exploration program in Alaska going forward.
So Willow becomes a hub.
That's the idea. The processing facilities, the pipelines, they're designed to handle more than just the initial Willow discovery. Future satellite finds in the area can potentially be tied back relatively cheaply to this existing infrastructure. It unlocks the potential of their entire Alaskan position for the long term. It's a big bet on conventional oil growth.
Okay, moving from that challenging capital update on Willow, Let's contrast it with some surprisingly good news on the capital front for their global LNG projects.
Yes, quite a different story there. While Willow costs went up, the LNG side actually saw a capital reduction. The total estimated capital for their three main equity LNG projects, that's Northfield East, or NFE, Northfield South, NFS, both in Qatar, and Port Arthur Phase I in Texas, has been reduced by $600 million.
Reduced, okay.
Yeah, bringing the total estimated cost for those three down to $3.4 billion.
A $600 million reduction is pretty substantial. Where did that credit actually come from?
It's specifically linked to the Port Arthur LNG project in Texas. It's a credit coming from the second phase of that project, Port Arthur Phase 2. Essentially, Phase 2 is reimbursing the Phase I equity holders, like ConocoPhillips, for some of the shared infrastructure costs that were paid for during the first phase construction.
Ah, okay, so Phase 2 is paying its share for groundwork that Phase already laid. Makes sense.
Exactly. It's recognition of the value created by the initial build-out, and it provides a nice immediate capital saving for the Phase I partners.
So with that credit factored in, these LNG projects must be getting pretty close to the finish line financially.
They are significantly de-risked from a capital spending perspective. They said about 80% of the total capital for all three projects is now complete, already spent or committed.
And the timelines for first LNG.
Still on track. We should see first LNG coming out of NFE in Qatar sometime in 2026. Then Port Arthur Phase I starts up in 2027, and NFS follows after that. And it's not just about building the plants. They're also making big strides on the commercial side, locking up customers for that LNG. Their target, their ambition, is to have commercial offtake agreements covering 10 to 15 million tons per annum MTPA.
Where are they now with that? I know they locked up Port Arthur Phase on.
They did. They fully placed the entire 5 MTPA of supply from Port Arthur Phase 1. That's done.
And they announced more deals this quarter.
Yes, 2 significant new agreements. They've agreed to take 4 MTPA from the second phase of Port Arthur, which is expected around 2030. And they also signed up for 1 MTPA from Train 5 of the Rio Grande LNG project, also in Texas, expected around 2031.
Okay, so 5 from Phase 1, 4 from Phase 2, 1 from Rio Grande. That gets them to 10 MTPA total.
Exactly. Reaches the bottom end of their 10-15 MTPA target range already. They're building a serious commercial LNG portfolio.
Let's connect this back to the bigger picture. Why is an upstream oil and gas producer like ConocoPhillips putting so much capital and effort into locking up LNG sales contracts? What's the strategic play?
It's a really critical strategic link. You have to remember, ConocoPhillips is one of the largest natural gas producers in the U.S., lower 48. Their production is huge, over 2 billion cubic feet per day.
Okay.
That 2 BCF per day is roughly equivalent to 15 MTPA of LNG. It's a massive amount of gas.
Ah, I see. So the offtake contracts match their production scale.
Precisely. By securing these long-term international LNG offtake agreements, they're essentially creating a direct pathway for their low-cost North American natural gas supply to reach higher-value global markets. It acts as a natural hedge against volatile and sometimes very low U.S. Henry Hub gas prices. They're controlling more of the value chain from the wellhead to the global market.
Makes sense. Hedging their U.S. gas exposure. Okay, let's try and pull all these pieces together now. We've got the Willow cost increase, but strong execution. We've got the LNG credits and commercial success. We've got ongoing cost discipline. How does this all feed into their forward look, especially that multi-year free cash flow forecast?
Right. The integration is key. Their preliminary guidance for 2026, which they based on a $60 WTI oil price environment, starts to show that inflection point clearly.
Okay, what are the headline numbers for 2026?
Capital expenditures are expected to come down. They're guiding to approximately $12 billion. That's about $500 million lower than the midpoint of their guidance for this year, 2025.
So capital spending starts to decline next year. What's driving that reduction? Fewer big projects needing cash.
That's a big part of it.
Huh.
The peak spending on the major projects, including Willow starting to phase down its spend, as we discussed, is easing off. Also, they expect to reach a sort of steady-state activity level for the Marathon oil assets they integrated in the lower 48. They don't need that initial ramp-up capital anymore.
And operating costs. Are those coming down too?
Yes. Adjusted operating costs are also projected to fall. They're guiding to $10.2 billion for 2026. That's $400 million lower than the guidance for 2025.
Where are those savings coming from? More efficiency?
Mostly, yeah. It's largely getting the full-year benefit from the Marathon integration synergies. They said they've already captured about 75% of those expected savings. Plus, it includes the impact of that ongoing $1 billion internal cost reduction effort they've talked about previously.
Okay, so capital down, Operating costs down. Are they having to sacrifice production growth to achieve that?
Apparently not. Underlying production for 2026 is expected to be anywhere from flat to maybe 2% growth. They've gotten much more efficient, especially in the lower 48.
How so?
They've managed to transition from running about 34 drilling rigs down to a more streamlined program around 24 rigs post-marathon integration. But because drilling and completion efficiency keeps improving, they can maintain or even slightly grow production with significantly less capital investment. It's that level-loaded, steady state they were aiming for.
All right, so lower spending, stable to growing production. That sounds like the recipe for higher free cash flow. What does this mean for that huge $7 billion free cash flow inflection they've been promising by the end of the decade? Does the Willow cost shock throw that off track?
This is probably a most important takeaway from the entire update. The guidance for that $7 billion FCF inflection remains completely unchanged. They are sticking to it.
Still $7 billion by 2029.
Still $7 billion of improvement by 2029 compared to the 2025 baseline. That's a number that could potentially double what the market expects them to generate in 2025. It's a massive jump.
And how does that improvement layer in over the next few years? Is it back-end loaded?
They've laid out the cadence pretty clearly. They expect about $1 billion of incremental free cash flow improvement each year, starting in 2026, going through 2027 and 2028. So that builds up $3 billion of the total $7 billion improvement.
Okay, which leaves the remaining $4 billion of that $7 billion improvement needing to show up pretty suddenly in 2029.
Yeah.
What triggers that huge leap just in that 1 year?
That massive final step up, the $4 billion jump in 2029, happens precisely when the Willow project comes online early that year.
Ah, Willow again.
It's driven by two things happening simultaneously with Willow's first oil. First, the capital spending profile flips dramatically. You go from spending, up to $2 billion a year on development before first oil, down to only about $500 million a year in sustaining capital after first oil. That's a huge saving right there.
Okay, capital drops off the cliff.
And second, at the same time the spending drops, you suddenly get the cash flow from Willow's production hitting the books. So lower spend plus new revenue equals that massive free cash flow surge in 2029. It's why management keeps calling this multi-year growth profile unmatched in the sector. It seems credible.
So wrapping this up, our deep dive really shows that dual narrative playing out. Yes, there was a significant, quite detailed explanation for the Willow cost increase, mostly inflation and local pressures, but it seems contained.
Right. And on the other side, the underlying business looks strong. Q3 execution was excellent. The LNG project actually provided a capital credit, cost reductions are ongoing, and the dividend is increasing.
Meaning that core story, the path towards that massive free cash flow increase by 2029, looks like it's still firmly intact, despite the Willow headline.
Exactly. The investment thesis they pitch, having this deep, durable, diverse portfolio, seems to be holding up. It provides the capital flexibility to handle shocks like the Willow inflation while keeping the long-term financial promises on track. That FCF step up in 2029 looks like it's built on decisions and projects already well underway.
Okay, so here's maybe a final thought, something for you, the listener, to mull over as you do your own research. The company is clearly heading towards this capital windfall in 2029, that $7 billion FCF inflection.
Yeah, it's a huge amount of discretionary cash flow coming their way.
So the question becomes, what do they do with it? We heard a lot about their commitment to these big, long-cycle conventional assets, Willow, the Surmont oil sands debottlenecking in Canada, this renewed exploration push in Alaska. Will that 2029 cash influx be primarily channeled back to shareholders through even bigger buybacks and dividends?
Or will they see it as an opportunity to really accelerate the development of those long-life, potentially high-return conventional resources to lock in production for decades further into the future, doubling down on that part of the strategy?
That choice, that balance between maximizing immediate shareholder returns versus accelerating long-term resource development.
That feels like it could be the defining strategic decision for ConocoPhillips, shaping their footprint, really for the next decade and beyond once that FCF surge materializes. Something to watch.
Definitely something to watch. We hope this deep dive gave you the clarity you need to understand the nuances behind ConocoPhillips Quarter and their path forward. Thanks for joining us.